First of all, to everybody here, those that did celebrate happy Thanksgiving to everybody, except all the bots that freaking keep hitting my replies on my tweets. I don't know what Musk is doing, but clearly on Twitter, I'm getting targeted. I tried to report it, but don't worry, folks. I'm not going anywhere. I'm very excited. Keith has got a very strong pedigree and certainly knows a lot about macro. And a lot of people, especially Brent Johnson, vouch for you, Keith. So I think this will be a great back and forth here. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Keith Dicker. Keith, for those who are not familiar with you, introduce yourself. Who are you? How'd you get involved in markets? And has this year been easy or hard when it comes to macro investing?
Well, that's a lot.
That's a lot.
First question. Started. Yeah. I'll answer the second one first. I think it's been a pretty easy year from a global macro perspective. So we'll jump into that. I think that's the main part of the conversation today. But for those that don't know us, so IceCap Asset Management, we're a Canadian-based firm. We're global macro. I founded the firm back in 2010, and we run absolute return portfolios with global macro perspective, and we've never had a negative calendar year. So we're getting out of 1 month left in this year, and we're running around plus 1% right now in that range. But we'll dive into what investors should be doing to really manage the portfolio. And the main opportunity in all cycles is really to avoid these sharp drawdowns that come out there. But one thing that's interesting with us and sort of our origin is that I am Canadian, but I was offshore for over 10 years. And the reason I just share that with everyone is because the biggest challenge most people have today in markets is that, first of all, you have to distinguish between the industry and markets, two completely different things. And then the other item, which I think is pretty important, is home country bias. Most people around the world, we tend to see the world through our own ethics and morals. So if you're Canadian, you see it as a Canadian would. If you're French, you see it that way. And if you're American and Aussie. But when you're offshore, the experience I had, I just sort of describe it as you're living in between the scenes of the world. And those that have been out there with that experience, you know what I'm talking about. There's not really any rules of the game to play. You're just simply living your life the way you want to. People leave you alone. But because you're sharing all this with other expats around the world, you really get to see things differently. And then when you carry that over in the investment markets, it helps you to appreciate why, for example, the US dollar has been incredibly strong this year, or why the outlook for the euro may not be as strong, things like that. But that's sort of the initial, hello to everyone.
On home bias, I think a big portion of that relates to the illusion of understanding your domestic policies, as if that gives an edge, right, around how to think about investing. How do you break that home bias if you're not a professional that's managing other people's money?
Well, I think one of the best opportunities everyone has today is compared to, say, 10 years ago and 15 years ago, at platforms like this. So years ago, you had to rely upon the industry. We're back to that concept again. Mainstream media to tell you what they think you should be hearing. But now that on Twitter, you're really one click away from hearing some interesting people, and you get that on other great platforms, and podcasts are out there as well. So I think if you're already in that space, and if you're listening today, obviously you're swimming around that water. And I just think it gives you a significant opportunity over that passive investor who's just told, to ride these cycles out and so forth. Because as we'll get into, Michael, this is not a normal cycle. It is actually the end of a pretty big secular movement that has taken place. And I just think because we're so close to everything, a lot of people don't see that big move, that the shift that has started. And that's where we're getting all these great opportunities coming at us right now.
Okay, so now help me distinguish between these two concepts. I've made this point before that, especially on Twitter, you have a lot of people talking macro, which is, I'd argue, much more about the endpoint, where things will get to. Whereas if you're a trader or you're particularly active, you worry less about the endpoint and more about how you get there. Right? I always go back to that point. Path matters more than prediction. Talk about, because you allude to this idea that this has been fairly easy. I think it's actually been remarkably difficult because the path is so abnormal in the way stocks behaved, in the way bonds behaved, in the way the two interacted to each other. What was the sort of major trade and allocation for you? It sounds like it's currency related, but talk through sort of how you position throughout this year.
Yeah, sure thing. So one is like obviously more short-term related and probably cyclical. And then the other, which I do want to come back to, is more this really broad perspective on why we're experiencing what we are today. Everyone knows by now, 2021 was this enormous risk-on market. And people were saying, hey, the lockdowns are going to be over. People are going to be out doing things again. Supply chains back online, all that. Whereas in our world, in global macro, it's simply, that was a pretty big risk-on, high beta event, in our view, solely because we had all this liquidity flushing in, not just from the main central bank, but from every central bank at the same time. And then simultaneously, we have this fiscal stimulus coming in. For example, up here in Canada, some people, or like to say sometimes, some folks got hurt economically, but people got paid not to work or just to stay home and, change the lifestyle somewhat. But if you look at all that stimulus from a monetary perspective and a fiscal stimulus perspective, and then towards the end of Q3 into Q4 of 21, in our mind, it was pretty easy to see that this year-over-year growth rate was coming down rapidly, especially with M2 growth from the four main central banks. And usually when that happens, as we know now, of course, you take that stimulus out of the market, that's going to create some headwinds coming up. So for us, the main thing we did for this year, one, that we identified, hey, we're likely going to hit into this risk-off market. And then you have to understand what the knock-on effects are from that. And because if one market is going to really struggle, by default, another market should do very well. So, one of the reasons we had a lot of success this year, and you did mention the FX side, we have about a 25% allocation on the FX side, and we're long US dollars, but if you look underneath what we're holding, like we're short euro, short sterling, CAD, Aussie, and things like that. So that's been acting as a pretty good positive return generator. And then on top of that, we've been quite bearish on the bond market now for a while. And if you think about, again, we're sort of jumping back to the industry now. The industry has always told you that some derivative of a balance fund is always going to protect with this or that. But the most conservative investors in the world, they've been pushed into bond funds over the last few years. And if they haven't been pushed out with duration to pick up yield, they've been pushed out into credit, into high yield, emerging market debt, and so forth. And in our mind, because we were likely going to move into this risk-off market, avoiding that market was pretty significant. So again, I opened the show by saying, I didn't mean to push anyone off sides, but we did think that the opportunity for 22 to be a bit of a struggle was quite high. And that's where we are right now, which of course means we're going to come into another cycle coming up here. And I love saying this quote, Michael, and you'd either laugh or roll your eyes, but outside of the institutional space, so most people, they buy high and sell low. It just feels great buying at the top of euphoria, and you feel relieved when you sell at the bottom. But, we are getting some pretty big opportunities rolling up here right now in our view.
So two directions with that, and then I'll get some of the audience here. First of all, do you get the sense that the currency momentum that you benefit off of is maybe turning, or do you think there's more movement in shorting the euro, shorting the yen, long the dollar? Because this is, I think, where it gets to be particularly interesting from a, let's call it, normalization standpoint, right? If you have at least some of this currency volatility subside, that probably would be enough to create the illusion of stability that risk-on investors need.
Yeah. So the way that we would frame it, it's not always going to be a binary outcome coming up. So what we prefer to do with our portfolios is to really have them structured so that if we do get one of these fat tail events coming up, we want to see what's going to happen with our portfolio. So let's just say right now that fat tail event, we'll just use equities as an example. Let's say equities come down another 50%, so half 100 over the next 2 months for whatever reason. We want to stress our portfolio to see how that's going to perform. And then we look at the other side. Let's just say equities go up 50%. Then we want to see how we're going to perform in that environment. So what I mean by that, the days of having equity fixed income portfolio, I think that was destroyed back in 08, 09. That's what the old guys used in the 80s and 90s, NDOs, and it doesn't work anymore. So instead, you have to move beyond that allocation and start adding other kinds of exposures to the portfolio to help sort of cushion through these big movements that are coming up. But again, I'm trying to say, like, we're not always going to have this binary outcome. So, for example, to say, hey, Europe struggled this year, that means it should take off next year. We have a view on that as well, which we'll jump into. But we're in this moment now, Michael, that we like to describe it as, we have synchronized risk around the world. And if you look at the world that way and you think about it, one would say, you know what, we've never had that before. We've always had a moment in time where, say, the Americans were struggling with something, or it was the Europeans or emerging markets, something like that. But right now, everything has been lined up perfectly. So I know when you announced this show for us today, for you and I, you referenced Canada. Maybe that might be one of the trigger points coming up. And that's a great example of it. Like one of these risk-off events can be triggered from the place that you're not expecting it.
Yeah, no, 100%. And again, I want to go to Piotr in a second, but I want to tease that out a little bit more, this idea of synchronized risk, because I saw that tweet that you put out, and I agree with you. It kind of goes to the whole argument I kept on saying, which is that the end of the world is the bull case, that the synchronized risk is actually in the illiquidity behavior of government bonds. At least that was the case, I think, towards the very end of September into mid-October. How do you view the government bond market at this point? You mentioned big opportunities. I've had people say to me, "Oh, is this one of those generational buys on government debt because they can't default?" What's your take on the level of yields when it comes to the so-called safe side of the fixed income landscape?
Yeah, so first of all, investors, you always have to tear open the bond market between sovereign debt, government debt, and credit.
And by the way, I will say that's something a lot of people don't really fully appreciate. There is a big, especially in the behavior, right, for high volatility. So the whole flight to safety dynamic, as you know, is not just a phenomenon in the U.S. where usually, except this year, when you have stock market volatility, treasuries benefit. But you look at the DAX, when the DAX goes down, usually bunds benefit. When the Nikkei index goes down hard, usually GGBs benefit. So there is a big distinction in the perception of the path behavior.
Yeah, absolutely. And as people will understand as well, it's different points on the yield curve. I sort of grew up in the equity world. That's what I was introduced to. And then because I was managing, multi-currency, multi-strategy portfolios when I was offshore, then you jump into everything. So you start to learn about a great deal of different markets. But for anyone out there who's starting today, you say, hey, I want to get into this industry and really figure things out. You want to go in the fixed income world, currency world. That's where you're really going to earn your stripes and figure out how things move. So with the question about how does this move? So let's first of all, let's make the assumption that whenever you view any market, think of it as a slide rule. So you have a 0% probability and a 100% probability of an event happening. Because it's global markets, and we won't get cheeky or anything, but let's assume it's never a 0 or 100%. We're sliding in between. That's where it's going to go. So let's make the assumption right now that we do not have one of these trigger events taking place, and the world goes into a recession. And probably the best case scenario right now, Michael, for the world is that we get a very shallow recession that lasts for a year or two. And I say that's probably the best case scenario because I think the world can adapt to that. There will be some losers along the way. Some capital is going to be reallocated and stuff like that. But you won't have this abrupt change taking place that's more exciting to talk about sometimes. In that environment, that's when I can envision a pretty great or a great opportunity in the long end of the curve with treasuries or government debt, depending on which market you're in. Because you're entering a normal recession. We all know now the yield curve has been inverted. But if we go into this recession, and what will likely happen next is that, earnings to come down, credit spreads should blow out. Nobody likes the bond market. So I think that is one of the big opportunities out there. But it's only if we avoid some kind of a trigger event. And I think the probability of that happening is a lot higher than what we're hearing about. It sort of goes back into what are you hearing from the industry and the mainstream media? And those that are inside the industry, they'll know what I mean by this. The industry is trained to always think in a cyclical perspective, in that you never anticipate a crisis will happen, or if you do, it's mum's the world. Mum is the word. You don't, you just don't talk about it and write about it. So that's why you always get people getting caught off sides. But what are you hearing with that, Michael, in terms of a recession? It seems like we're going to get one, but right now the data is sort of just slowly pushing us in that direction.
I mean, look, I first of all, just for some context, like when I say this year has been challenging, I'm talking from the standpoint of that abject failure of treasuries against equities in high volatility of equities. Historically, when you have these high volatility sequences, government debt tends to be the beneficiary. I always go back to that point that risk off means credit risk off, does not mean no risk, right? It means default risk off. That's sort of the core idea. And I'm shaking my head as you were talking about the trigger event. This is where I think this gets to be challenging. Now, I might make this argument that maybe this FTX blow up ends up having a spillover to equities. A lot of people say, well, it's nowhere near like a wave because of the sheer amount of leverage. And my pushback is always that a butterfly can always create a hurricane, right, in a chaotic system. So you never know what that trigger is going to be. And it could be something that you would never imagine would be the trigger because it seems so small, but can create a cascading series of events that results in, the deflation shock, which is usually what these tail events tend to look like. So that's always kind of in the back of my mind. I tend to be much more shorter term and intermediate term using these different signals I'm known for. I get the sense that the bear market probably is not over and that the damage is done. It's just that it's taking a while for it to be felt in the economy, given how fast the move has happened in the US, right? So, yeah, I don't think raising rates from where we are another 100 or 200 basis points is going to slow down housing more. So, housing's probably stopped for a while, which we can talk about also in the Canadian context.
Yeah, it's one great thing about the market this year is, by the way, like we're pretty agnostic towards everything. Like we never love or hate anything. We like to say we like or dislike it. But one thing that's been good about the market this year, it's just been a trend. Do you know what I mean? Like we've never had this large, like holy crap moment taking place. And it's when you get that rapid escalation in stress, that's when all of a sudden you see financial institutions, going off sides. And I know there's been stress under the hood at a lot of places, but we still haven't had that one moment yet. So that is positive. So next, let's sort of swing over. We sort of talk about, is this going to be a normal recession? And I don't think hope is a good strategy for anything, but I think the world should hope that's what we get, because otherwise it's going to be something that won't be rather pleasant. But so let's take the perspective that everyone, they'll start with the Fed, and then again, you go back to this home country bias or market bias. You have to look at everyone else. So this whole view that risk has been synchronized around the world. So let's picture, the Americans are in the middle. That's the largest economy and the most capital and stuff like that. Then let's sort of go around the clock, and we'll start with the Canadians up north. So for 10 years, we're basically at zero rates and QE. Then you go over to the UK, they were the same thing, same with the Europeans and the Swiss and the Danish and the Swedes. And you come down around the emerging market world, they weren't at zero, but they were pretty low. And then you had the Aussies and the Kiwis, and then, the Japanese have been in their own, monetary world for a long time. And now all of a sudden we've reached this moment where, 10 years of socializing the bad debt problem. By the way, I met Mark Carney a few years back. So he used to head the Bank of Canada, Bank of England as well. And it was back in, I think it was 11 or 12. It was just after the 08-09 crisis. And, when I asked the question, I said to him, hey, so what about this socializing the bad debt problem? Like, what are you guys doing with that? And he looked at me and said, we don't like it, but we have to do it. And I was surprised he actually admitted it. But the point was, as long as you understand what central banks are going to do, then that's all you need to know. I think it's sort of irrelevant for one person to say, I think they should do this or they shouldn't do that. Instead, hey, let's listen to them. So, you bear that in mind. Socializing the bad debt problem means everyone in the society, we pay for all this debt that's being taken on, which also means savers get screwed. So the little old lady who was living on 5, 6, 7%, term deposits, playing bingo on the weekends. She couldn't do that anymore. She's getting zero and so forth. But when we put all these together here now, and then you look at the response from the pandemic, all of a sudden, everyone started raising the short end, race at the short end of the curve. The long end of the curve started to blow out as well. And it's taken this moment where all of a sudden everybody that borrowed excessively in 2020 and 21, now all of a sudden that they're having these moments or experiences where their interest burden is increasing. And it's not a linear increase, it's an exponential increase. We'll talk about that in Canada as well. But when that happened, all of a sudden, it's no longer just households or corporations. For the first time ever, we're seeing it at the sovereign state level. And that's my point to that. No one has experienced this before. So first of all, we had the Japanese. Remember they capped the yield curve? They were about maybe 2 months ago now, I think. Was it 2 months ago?
Yeah, sounds about right, yeah.
Yeah, 2 months ago. So that for everyone, if you realize or not, the Japanese say, we'll never again let the 10-year go above 0.25% on the yield on it. And to achieve that, they said, they'll print unlimited yen to do it. And then, of course, that caused the currency to come off sides. And then we had the experience over in the UK as well. That seemingly came out of nowhere. And all of a sudden, they just announced yesterday and the day before that they're effectively going to protect the bond market there as well. And they're also be very mindful of weakness on the currency side. Meanwhile, we have the Europeans with the ECB. They're trying to pull off the greatest trick. They're trying to raise rates, but then they're also doing QE on the long end of the curve to help members of the Eurozone there, specifically Italy. And then up here in Canada, we're raising rates, we're doing QT. Now we're starting to see stress develop here. So when you put all this together, you would think, my God, the Treasury bond market for Canada or the UK or anywhere else, you want to short that or you don't want to buy it. That's the market that could experience the risk-off event. It could happen. However, it's our view that the central banks and governments in all of these sovereign states, they cannot let their bond market experience a crisis. Because the moment they do that, and the way banks are structured with regulatory capital, which is sovereign debt from their domestic country, they start toppling because they're levered entities. The pension funds go under, the insurance companies have losses and so forth. So because we know that it's unlikely that central banks will allow their sovereign bond market to go off sides, then by default, the risk has to come out from somewhere, likely be in the FX market. So that's one of the big opportunities that continue to come up on our side.
Yeah, you're basically making the argument I kept on making, which is that the end of the world is at hand. That's why meltdown's about to take place. I was basically making the case that if you didn't have bond market stability, nothing matters anyway, because if your collateral, which all your global leverage is based off of, is more volatile than that which you're leveraging against it, the system fails, right? So you can't make that bet. I maintain that point. That was sort of, I think we were much closer to that than people realize. And that's a good transition actually to that question when it comes to the UK.
Well, to be very quick about it, I think the Eurozone is screwed. That's pretty much to the point. I like the joke. Our target price for euro is, I think today it's probably 104 points away. Going to zero. That's dramatic.
Your target price is FTX coin, which by the way still has value and is trading. On a side note.
Yeah, with all of these studies, and that one, that's suggesting that the UK is going to experience like the sharpest drawdown in 40 years. So two things. Obviously, it's extremely dramatic. Another viewpoint with it, for that to be published, they have to get the okay to do that. So I'm skeptical about a lot of things. I don't think we live in this nice, clean world where everyone operates on this independent, neutral perspective. But I think certain messages are sent out for certain reasons. But in the UK, there's certainly some struggles coming up. But on a relative basis, the advantage that the UK does have over Europe, over the continent, is that it does control its own monetary policy. Its debt is consolidated. It's still one of the major capital flow centers of the world. And, the Europeans don't have any of that. They have a lot of struggles coming up. And one of the main struggles and I never see any airtime for it. But it should be discussed more. Maybe, Michael, you can do this on a daily basis, bring it up. But the whole price discovery process for European sovereign debt, it's been suspended now for about at least 10 years. So what is the true price of an Italian 10-year bond? People might say, oh yeah, it's a 4% yield or this. I would argue nobody knows. Like the last time it was allowed to float was back during the Berlusconi days when he was, kicked out in the middle of the night. And so for that reason, whereas the UK, obviously the Bank of England will try to control the gilt market now. Foreign capital is still going to go into the UK if they think there's an opportunity there. If I'm running a lot of foreign capital, it's a lot of capital, and I have complete liquidity and control over it, I'm not going to go into the Eurozone with it or the EU. I'm just concerned about what the actual price of different markets would be underneath it. So I don't know if that provides any guidance with you. Well, I mean, just to be clear, the UK and Europe is not a market we're favoring right now. So the distinction between the UK and Europe, I would look more at the UK. I mean, I think we're looking at, we may be splitting hairs of some sort here coming up. But what's interesting with the UK experience over the last month or so is that if you look at the structure of the pension industry there and the banking industry, even though it's a lot larger, a lot deeper, it's very similar to the Canadian experience. It's likely very similar to the Aussies, what they have. And maybe the Japanese as well, to a smaller perspective. So I suspect when the UK had those stress points within their bond market, the gilt market, with pension funds and so forth, I'm pretty sure it was happening elsewhere around the world. And that's my point in that, where is the trigger point going to come from? And it could be, again, it could be Canada, it could be somewhere else. But the moment that we get another severe risk-off moment happening, that could be the point where any capital around the world that is able to move, it's going to run for safety and cover. And then whether people like it or not, the only market that's big enough and deep enough and liquid enough to absorb that is the US. So again, I mean, we have this view that we would love to see this real shallow, people struggle a little bit and we work it out. But I don't believe that's where we're going to go. And by the way, if the UK does experience, the worst recession in 40 years and stuff like that, that's going to spill over elsewhere. So that won't, just be another UK specific event.
By the way, speaking of trigger events, as we're talking today on the 25th, Credit Suisse hit new lows. Anyway, more of a side note.
One thing I loved about, I don't know if people picked up on it, but by the way, we can be pretty quirky. We think we have a really cool sense of humor. But I love the quote how you didn't introduce the concept of cannabis here in Canada. And then later on, you said Canadians are high on real estate. So you gave me a chuckle with that here on a Friday afternoon. I hope other people are chuckling, maybe. But to answer your question, so first of all, will there be any kind of a fiscal or monetary response? There absolutely will be. I mean, that's the world we're in today. It's been established time and time again that capitalism has been muted or not really allowed to do what it's supposed to do. And what it's supposed to do is that if you take on a risk and you make a lot of money on it, you should keep that money. If you take a loss, then it should be your loss. But what I suspect is going to happen very soon, likely going to see the Bank of Canada do this pivot, what everyone is talking about. For those that are not following the Bank of Canada, that they're probably the most non-transparent central bank out there right now. And so what you should want with your central bank is that they're guiding you with what their interest rate path is going to be. And the Fed is really good at that. If they think the market has gone off track, they're going to tell you. They're going to say, no, you guys are offside. You need to come back here. With the Bank of Canada, it's a guessing game. So right now, because we do have a lot of these mortgages that are going to have to be rolled over and burdens are going to be high, You just know that the Bank of Canada, they're definitely aware of this. They're chatting with, the big five commercial banks every day about this. They know what they're being told, what risk is out there. So I wouldn't be the least bit surprised if you see the Bank of Canada stop very suddenly after the next meeting. And that's great because there are some really great ways to play that in the market if that's where we're going. But for the Canadian marketplace, you mentioned that we have this recency bias with real estate. The other thing that Canadians have never experienced before is a crisis with our banks. And because of that, we have this feeling that we're invincible up here. Remember how everyone thought the Icelandic industry were like superior bankers than everyone else? And it turned out they weren't. They're just using leverage. But here in Canada, people feel that their banks they can withstand anything. And the regulators know that as well. So I would imagine the moment there is the slightest hint that there is stress escalating, you're going to see a pretty quick movement. So, Michael, do you have anything to add to that as well? Does that make sense?
No. I mean, I'd echo that. I think, the other thing I would maybe counter is that I actually think transparency is the exact opposite of what you want from a central bank, only because one of the most powerful weapons by any policymaker is the element of surprise, right? I've always had this more of just a side note. I've always found it myself to be problematic when the Federal Reserve is trying to over communicate. I think it actually hurts them in terms of another policy tool, which is moral suasion after the event, happens and after they start acting. But hey, more of a side note. All right, let me reset the room for the remaining minutes here. Everybody that's here, please make sure you follow Keith Dicker here on Twitter. If you are in Canada and are interested in some of his services, obviously check out his firm and his portfolio management services. Again, my name is Michael Guy. This will be available on all your favorite podcasts under that Lead Lag Live banner. All right, I want to go back to the question of uncertainty. How do you deal with uncertainty? It seems to me like we're in a world where when you have so much leverage, butterfly effects are more prevalent. Small things can have bigger changes, can cause cascading margin calls, which means that you end up having more and more tail events, I'd argue, and more things that are abnormal relative to history. Again, in terms of sequence and path behavior. From a portfolio management perspective, Keith, what do you do when really there is no precedence? Do you simply trade smaller? Do you step away? How do you manage the uncertainty when there's no real clear parallel in history?
Yeah, well, first of all, I think everyone has their own style and comfort level with risk and volatility. And, some people can tolerate a lot of daily, weekly, monthly volatility, and others cannot. The opportunity today, and I think this is really great in that I've already suggested that the whole price discovery process in the bond market especially, it's been suppressed for over a decade. And people from your university classes and CFA and all that stuff, everything gets priced off the yield curve. It doesn't matter what market it is, that's where it's getting priced off. So when nothing has been allowed to be truly priced where it should be, there's risk at play here. So we have two opportunities today. One, you can recognize that and make sure you have exposures that can help you if we get one of these, price discovery moments coming back on side. And probably the easiest one, again, I keep going back to the currency world. There's ways you can be very sharp with it and acute with it. And to make it very simple, if we go to a risk-off moment, the US dollar will surge. If it's a risk-on moment, then you have the opposite taking place. So that's one key addition to your portfolio tools that you can make, and that can really help even out the playing field. The other thing that I think that's interesting today, and there are a lot of great new products that have been created in the ETF space, especially. So they're available to everyone. So you don't have to be locked into this old 60-40 model that it's broken. It doesn't work anymore. But you're able to go out and you're able to get non-directional strategies. You're able to go in the different parts of the commodity sphere, like agriculture commodities, for example, things like that. And I think that will help people to properly structure a portfolio so that you're going to be invested. So you should be able to continue to produce positive returns. but you're also not going to lose your shirt, like if you go off sides. And so that's where we have success, of course. So putting it together. But by doing that, of course, you limit your upside. You're not going to get these, 20, 25, 30% years, but, you're also not going to, blow the doors off it either.
Is there some macro trade that you're eyeing that, you're just waiting to pounce on that you think could be at some kind of inflection point nobody's seeing or talking about? I mean, you mentioned this idea that there are these significant opportunities. What are some of the ones that probably most excite you that you're close to pulling the trigger on?
Yeah, and a couple of these they're just not, one is not available to the average investor. You need access to some OTC products and so forth. That would involve the Bank of Canada, for example, doing a pivot. For everyone else, to give you an example, like our style, like we're cool guys, but we can be pretty unexciting in terms of the normal routine. But we've been waiting to add crude oil to our portfolios now since last March. And we thought we would get the opportunity this fall. So now we're finally here, and we're seeing that is beginning to happen. So that's one opportunity. And by the way, one key observation we have with oil right now, I know people have noticed this over the last few days, but in our mind, the pricing dynamics with oil is now shifted from a supply story to a demand story. And the demand story is that, hey, we're headed for a recession. And you look, okay, how do you reconcile that? And you can reconcile with the movement in the 10-year. So the 10-year yield, we've gone from about in the US now, about 4.25 maybe, to 370, where we are today. So you're starting to see these dynamics take place. And another long-term opportunity that we're super excited about is in the agricultural commodity space. A combination, the weather is changing, yields for farmers, it is declining because of climate change policies from the West, and specifically in the fertilizer space, if you know that story. So again, these are more longer term plays. And the idea, of course, is to buy low and sell high. And I think sometimes people get too caught up in the daily excitement of what's happening. For equities, real quick, we suspect we might have one more. This seems to be a bear market rally in our view that we have here right now. But if we get a recession coming up now, likely in Q1, starting around the world, that's when you want to start getting more interested in equities. So a lot of people, they have this false belief that equities are reconciled with the economy, and that's not true at all. I mean, equities have come down pretty hard this year, and what's happened with the economies around the world? They've been okay, right? They haven't been in a recession at all. But we could have that moment coming up. And, one thing we'd love to do is when any market is in euphoria, we just love that. So, with the whole crypto space last year, we didn't touch it at all in our mind. Not only were we not smart enough to understand it, we were smart enough that we've lived through some of these euphorias before. And we could just see it for what it was. So that's the space now we're suddenly getting interested in. Again, it sounds a bit off sometimes, but in the investment world, you have to be pretty cruel and don't show any love. When there's blood in the water, that's when you start looking for the opportunities. And so that's what gets us excited right now. But the biggest excitement coming up for us is that the probability of stress escalating, we think it is quite high. And if that happens, then we are going to see some kind of major credit event and a currency event taking place. And that could just swamp all the different markets. So you want to make sure you have protection should that event take place.
I'm with you, by the way, on that. I've called that, the return of quote unquote real risk off, right? So you haven't had spreads widen despite the bond market carnage. It's been primarily a government duration sell-off, not really a default risk increasing type of move. And that's still coming. If you believe that at some point recession is coming, that almost has to force the flight to safety trade back, which would result in some really good opportunities for high yield after the credit spreads blow out, right? But I'm with you. I think that's still coming.
Yeah, I mean, that's the great. I mean, we always like to reconcile different markets. And the fact that credit spreads, they widened a little bit, but, nothing got to that point where you're still like, holy smokes, this is bad. And because, if you look at what happened with credit spreads back in March of 2020, the Fed had to step in. I think they did buy a bit of high yield, but they carried a big stick to threaten that they're going to buy high yield to bring it back in. And you come up here to Canada, of course, you could see this scenario where the 10-year, it's coming down aggressively, But yet, to rescue the housing market, are commercial banks going to follow that, that rate path downward? I'd be shocked if they did. That's an example of credit spreads widening up here in Canada. But the housing market in Canada, it's a bit of a cult, I think. People are here, they're living it, they'll know what I mean. There's a lot of pretty strong feelings about it. But we're all, wrestling with that up here these days. But the same for the Aussies as well and other markets that went through it. But what does make it a bit frightening for Canadians, so if you understand it, is that we haven't experienced it before. We are aware that other countries have. So people are just sort of hoping it's not going to happen. And the final word with Canada as well, even though like everyone up here now, we're all talking about the recession, but it's coming, it's coming. But the data is not really showing it as arriving. One of my good friends is a labor lawyer. So they would see firsthand when layoffs are coming and stuff like that. And there's not a lot of signs of it yet. So, people are aware of it, but it still hasn't dropped yet. So people are waiting to see where we go.
Yeah, I'd say it's probably a similar dynamic in the U.S. Everyone's always talking recession when it comes to the financial media world, but people are still waiting outside of outlet malls, overnight for deals, right? And still spending, and airports are still jammed. I mean, it's just an interesting dynamic. Let's do one more question again. Everybody here, please make sure you follow Keith Dicker here on Twitter.
And I'll go first real quick here. So in our world, by the way, on Twitter, there's a whole bunch of private DM groups behind the scenes that a lot of people don't get to see. And in those groups, you'll laugh if you know it, we all want the event to occur that's going to best profit our books. So you have to bear that in mind when you see different comments on Twitter, for example. People calling for light recession, they're equity bulls. People calling for the opposite, they're probably short and whatever. But the real question.
So what you're saying is that people are biased. That's breaking news, I think, here on Twitter.
Yeah, it is the internet. But in my view right now, it just seems to me, again, this is just a thought and a feeling with it. People are still very much, not too much focused on whether a recession is going to affect markets. They're really focused on which direction the Fed is going to take next. So we have to push through that. But one, you did bring up a really good point, though, and I meant to talk about it. It just didn't come up. What's happening in China with these COVID lockdowns? And the word I'll use to describe it is not something you'll find in the CFA textbooks. It's weird. It's just highly unusual what is happening over there. And because we're skeptical about a lot of things, we are aware that their banking system, it is struggling. We are aware that there's a lot of capital trying to get out. And by the way, when the Chinese sell their treasuries, it's not because they're bearish on the US, it's because they need US dollars to fund capital outflows. We know global trade has slowed, so there's not as much foreign capital currency coming in for these guys. I just think that China might be this surprise moment where they do devalue the currency, which could also then immediately affect Hong Kong dollar as well. But again, it's an example where how we started the conversation today is, don't just look at the world from your own market. You have to understand that every place has something going on with it. And I don't think that I think China is I don't even think it's a mystery. I think it's very well known that they have a lot of struggles right now. And it's just their choice whether they decide to trigger it themselves or something comes off sides.
Yeah, I'll echo the bias point and say that one thing that you realize being in this industry is that people's perception around how long something lasts is a function of recent price movement, since we talked about recency bias a bit before. The reality is narrative always follows price. Markets are forward-looking, narratives are not. And even when it comes to the question of duration of a recession or how deep, if the S&P is down 30% from here, I promise you everybody's going to be thinking it's a very deep recession that lasts for a while, right? So even though it could end up being a nothing burger. I mean, a lot of people thought that the COVID lockdowns would result in a prolonged, almost Great Depression-like period, and all it took was 3 months for that to change, right? So, I'm always myself kind of cynical of these types of things. But with that said, everybody, again, please make sure you follow Keith Dicker here. Keith, really do appreciate your knowledge. Good turnout. I appreciate those that ask questions, and thank everybody for joining. Thank you, Keith.